As Nigeria prepares to implement sweeping changes to its tax system starting January 2026, citizens, businesses, and investors are bracing for a new financial landscape. Signed into law by President Bola Ahmed Tinubu in 2025, the tax reform package touches nearly every segment of society, from low-income earners to multinational corporations. At the heart of the reforms is the promise of fairness and economic efficiency. For many salary earners, especially those on modest incomes, the new law offers immediate relief. Individuals earning 800,000 naira or less per year after deductibles will be fully exempt from personal income tax. This means the large majority of workers will either pay significantly less or nothing at all in a pay-as-you-earn tax. For the average Nigerian workers, this is a welcome change in a time of rising inflation, currency instability, and dwindling purchasing power. Small business owners also stand to benefit. Enterprises with an annual turnover below 100 million naira and assets under 250 million naira are now exempt from major taxes like companies income tax, CIT, capital gains tax, CGT, and the newly introduced development levy. This shift is expected to spur entrepreneurship, ease the burden on small-scale operators, and encourage formalization in a sector where informality has long dominated. However, these gains for the bottom and middle of the pyramid come with new pressures at the top. High-income earners will face steeper marginal rates, and companies, especially large ones and multinationals, will now pay more. The top marginal personal income tax rate has risen to 25%. Corporate tax remains high, but new rules introduce a minimum effective tax rate of 15% for large corporations, ensuring that companies benefiting from loopholes or tax incentives still pay a baseline amount. The biggest shock, though, may be in the area of capital gains. For companies, CGT will jump as high as 30%, aligning it with corporate income tax rate. This puts Nigeria among the highest tax countries for capital gains in the region and could trigger a shift in investment behavior. Some investors are already expressing concerns about the potential flight of capital or slowdown in market activities, especially in equities and real estate. Compared to developed countries, Nigeria's new tax structure is mixed. While the top income tax rate remains lower than in many OECD countries where marginal rates often exceed 40%, Nigeria offers fewer public services in return. In wealthier countries, high tax